In my opinion, holding a growth ETF over the long term is a very good strategy. You may ask yourself why. They perform traditionally really well. The one we're looking at today, the Vanguard Growth ETF, or VUG, has gone up 140% over the last 5 years. Traditionally, they will outperform the S&P 500 over the long term. The S&P 500 is usually the benchmark that we look at. Top 500 companies in the United States, how have they done over the last year? These growth ETFs generally outperform. So up 140% is really good. If we zoom out, it looks even better, right? Since 2004, up from 50. If we go back about a decade, I always like to look about a decade. It was at 102, maybe 105. So you're up, right? 3x, 4x in this time frame pretty easily. That's really good. The S&P 500 over the last decade is only up about 90%. About 200%. Over 5 years, it's up about 90%. And like I said, VUG is a really good ETF. We can see its historical return is above average. Historical risk is above average. So the only downside you really have to these, if you were really close to retirement and you needed the money, if you had a large portion of your retirement money that you needed, right, in the short term, it would not be a good idea to hold all VUG or high growth ETFs, because in the short term, if there was a market downturn, it is going to go down more than the S&P 500 as well. It's going to perform better over the long term. But if you needed that money in the short term, it wouldn't be necessarily a great idea to hold too much of growth stocks. Let's just say for this example, VUG, or growth ETFs. I mean, growth stocks in general. It is generally growth stocks. We can see the breakdown here. 33% large growth, and then a decent blend, but you have almost no value stocks here. And value stocks tend to hold up better in a market downturn because they're more stable. The products they do are generally less, a growth stock like Pepsi, right? People really aren't going to stop buying Pepsi if there was a major recession. However, the newest cutting edge iPhone that's $1,600, although it's good, if money's tight, you probably aren't upgrading to a new phone. You're just going to bite the bullet, or you're going to get the cheaper option. So generally, and that's just one example, but generally during a recession, smaller caps, smaller or value stocks generally do better. So this stock will go down in the short term, but in the long term, because of tech and the growth stocks are generally have gone up more, you're going to do better in the long term. And we can see another thing is it's really heavy into tech. I love tech. Tech is great. 47% of this particular ETF. Then you got a mix of some other stuff, but like I said, barely any real estate, barely any energy, utilities, consumer staples. These are all the dividends. These are all the value stocks that you have, and there isn't many in this. You can see a lot of the top companies: Apple, Nvidia, Microsoft. And yeah, it's really concentrated at the top. I mean, basically a third of this entire thing is just Apple, Nvidia, and Microsoft. It's going to be heavily weighted towards the best performers, which is good and bad. It's good because the best performing stocks, believe it or not, are the best performing stocks, and you're going to have those. And then long term, if those were to do poorly, you'd have new ones that would carry. But as long as the big boys are running, you're going to do good. Yeah, like I said, we can see some of the long term, or some of the ratings. We got 4 stars there, 3 stars for the 3 year, which is a little weird. I feel like it's done a bit better than that over the last 3 years, but I guess it's just because it peaked in 2021. But the 3-year rating in about a year is going to look much better. 5-year 4-star, 10-year 4-star. It's a good fund. It's going to do well. It's probably going to outperform the S&P 500 in the long term. I would have a large percentage of my 401k in it. I do. I have my 401k primarily through Vanguard, and I have VUG as a large portion of it. I'm not going to tell you what to do. This isn't investment advice. However, this is pretty standard. Having ETFs, growth ETFs, S&P 500 ETFs, that's pretty standard financial investment advice, although this is just education about the specific topic. I'm not recommending anyone to do anything, but me personally, I buy this. Over the long term, 20, 30, 40 years, it's going to do well. Even 10 years. The only thing, like I said, if you were like 5 years out from retirement, you needed the money specifically. Yes, VUG, growth ETFs is probably too risky, and I would move some of that money maybe into value, dividend, or bonds. Like I said, if you needed that money. But over the long term, VUG is going to do well. It's a great ETF. I like it. You should do fine. If you enjoyed this video, I appreciate if you left a like or subscribe. I appreciate when you do that, and I hope to catch you in a next video. Thanks for watching.